It's no secret that the market is pretty pricey right now. PE ratios over the S&P 500 are nearing the levels of the dot-com bubble. The Buffett indicator is 73% higher than the long-term trend, and people are constantly saying that we're in a bubble, a market crash is coming. But with so much of the market at all-time highs, it can be harder and harder to know where you should invest the rest of your money. Well, in this video, I'll be going over the 5 dividend stocks that I think are undervalued. But first, if you enjoy the video, I'd like to ask you to like the video and subscribe down below. It helps get these videos out to more people and helps me out a lot. Now with that out of the way, let's jump into the first stock on the list. First up, we have Verizon. Verizon is one of the 3 big self-service providers, along with AT&T and T-Mobile. They currently have the largest number of users of the 3, with 121 million current subscribers. One of their next big projects is building out 5G infrastructure to use the 5G frequencies they recently bought at the start of the year. Verizon is currently trading very close to their 52-week lows. Their forward PE ratio is below 10, and they're trading at a nice discount to their fair value, which I've calculated to be around $63, and you can see my calculation here. Looking into their financials, we can see that they are by no means a fast-growing company. Revenue has increased by 7% since 2016. EPS growth has been a bit better during that time though, growing by about 65% over the last 5 years. Like other companies in the telecom space, Verizon has a ton of debt, with their total debt currently sitting at $178 billion. It would be nice for that number to start going down, considering that they are very leveraged, but they just recently took out a large amount of debt to buy the 5G frequencies that I mentioned earlier, and that's a necessary purchase for them to continue to grow and compete into the future as we develop newer technologies with communications. Jumping over their dividend information, we can see that their current dividend yield is about 4.9%, and they have a decent payout ratio at 47.5%. But just like the revenue, the dividend is growing very slowly at a compounded annual growth rate of just 2%. They've been growing their dividend for the last 15 years. Seeking Alpha is just missing a payment in their historical data, so their dividend growth count isn't exactly right. Looking at how Verizon has performed in the last year, it's clearly not good. It's severely underperformed the S&P 500, losing about 14% since this time last year. And there's a number of different reasons why I think this may be happening. One that started back at the beginning of the year, back in February, was the 5G auctions. All of the telecom companies, except for T-Mobile, ended up paying a lot more than was expected. And Verizon ended up spending about $45 billion to acquire different 5G frequencies. Verizon also sold off their media assets for about $5 billion, taking a loss on that, leaving them to just be a pure telecom company, and we later found out that AT&T was going to be doing the same thing. Back in October, a number of different analysts cut their price expectations for Verizon, which led to this sell-off here. Also, Verizon slightly missed on revenue in the last quarter, despite beating EPS and having improved guidance. And news that came out on November 4th was that Verizon and AT&T are both going to be delaying the startup of their 5G projects until January because of airline safety concerns from the FAA. So I don't think any one of these reasons is like the sole reason for these declines over the last year. It's just the combination of all of this news over and over and over again, spread out through the entire year. Overall, Verizon isn't going to triple in value the next few years. It's likely going to stay flat. It might go up a little bit because I think it is undervalued at these prices. But I think it's better to think of Verizon like a bond. It's going to be paying a high-yielding, reliable dividend, but the value of the stock itself probably won't change that much. And unlike a bond, the payments are increasing, albeit pretty slowly. So I wouldn't go and make this a big position or anything. I have it just under, it's somewhere between 2 and 3% of my total portfolio. But it will help bring a little bit of stability into your portfolio and provide some nice income. And that's all we have for Verizon. So let's move on to what stock number 2 is going to be for this week, which is Intel. Intel makes all sorts of products, from their CPU lines to their server products to Wi-Fi products and solid state storage and persistent memory and all sorts of different things. They make a huge range of different products used in all different types of systems. Intel is one of the stocks that I've gone back and forth on several times on whether I wanted to re-enter, because as some of you may know, I did used to own this, but I sold it back before the start of the year. And there were a couple of reasons for that, mainly just my own ignorance. I just didn't really understand what I was doing at that point, but I have a better understanding of what they do now, so I've been considering getting back into this, but I haven't made that decision completely yet. They've had a number of significant dips in the last few years. Obviously, this is from the pandemic. This happened pretty much to every company. And then this is where I bought the first time. It was right around $60, which was, in hindsight, a pretty bad time to buy, because it was immediately followed by earnings issues, and they fell down into the 40s, and then they started to do better, and then they fell again in earnings, and they were doing okay, and they have a new CEO, and they kind of felt like they're going to be turning around, and it's just been doing poorly for the last few months, really since the peak here back in April. They've just been going down pretty much consistently. And for the year, they're up about 12%, which isn't a bad return. Their PE ratio is really low, sitting around 10, and their fair value is significantly higher than the current price. Here's my calculation for it, and it's in the $70 range. So there's room to have a huge margin of safety if you did want to get in now. Revenue has grown by about 32% since 2016, and EPS has grown by about 140%, in part thanks to aggressive share buybacks that they've been doing for a while. Their shares outstanding have decreased from about 4.7 billion to about 4.2 billion in the last 4 years. Intel does have a decent amount of debt. At last report, it has about 35 billion, but with the large cash flows that they're able to generate, they can definitely handle it at these levels. Now moving over to their dividend information, we can see that Intel has a great dividend summary. Their current yield is about 2.7%, which is really high, especially in the tech sector. They have a low payout ratio at 26% and a decent compound annual growth rate at just under 6%. And they've been growing their dividend for the last 7 years, and another increase is expected to be declared in January. The big risk to Intel is competition. AMD and Nvidia both currently have faster chips, and Intel has been losing deals with companies like Apple to provide chips for their MacBooks and other products. Apple has decided to go and manufacture their own chips. Intel has also had delays in developing their 7nm chips, and the industry is already working on 5nm. And some companies like Apple already have them done. However, both AMD and especially Nvidia are trading at ridiculous valuations. Intel has massive cash flows that will allow them to dump tons of money into R&D to catch up. Intel is still a massively larger company than the other two in terms of revenue and profits. Intel is cheap right now, and they can get back on top again. And for stock number 3, we have a real estate company that if you've been watching for a few months, you know that I've been talking about for a while now, and I'm continuing to keep buying it, and that is Vici. Vici is mainly a casino and gaming real estate company. They own a huge portion of the Vegas Strip, and they're making acquisitions to become the largest landowner there. Vici is currently trading at a relatively low price to funds from operation rate, right now at 15.6, especially compared to other REITs like Realty Income, which is trading with a price to funds from operation rate of 20.5, MGM Growth Properties, which is being acquired by Vici, which has a 16.2 multiple, and Stag Industrial, which has a 20.7 multiple. Despite this lower price to FFO, Vici is growing faster than all of these companies. Vici's total revenue between 2019 and 2020 grew by 36%, despite this being a pretty bad year for REITs across the board. Realty Income grew by 10%, MGM Growth Properties grew by 0.06%, and Stag Group grew by 19%. The adjusted funds from operation rate for Vici grew by 28% between 2019 and 2020, while Realty Income grew theirs by 11%, MGM by 2.6%, and Stag by 23%. Because of this high growth combined with some unique risks that Vici has to deal with, I personally think Vici deserves to be trading closer to an 18 price to FFO, which would put the share price around $33. There's about a 14.5% discount to that price right now. Like most REITs, Vici pays a pretty high dividend. The yield at the time of recording is about 5%. It also has a really decent growth rate. Vici is a newer company, so it doesn't have a 5-year compound annual growth rate, but if we go and look at their history and through all of their different payments, compared with the first full year of payments that they had to now, to what their forward projection is going to be after their most recent increase, their dividend has increased by 25%. REITs, by their very design, have a very high payout ratio, so the 78% here isn't anything to worry about. If you look at any REIT, their payout ratio is going to be somewhere in the high 70s to like the 90 range. Vici isn't without their risks, however. They're very concentrated to only a handful of properties. As of right now, they only own 27 different buildings and 4 golf courses, with 31% of their portfolio being exposed to the Las Vegas Strip. So this makes it seem like they would be pretty sensitive to recessions. However, as we saw during the pandemic, Vici collected 100% of their rents. Their largest tenant is Caesars, which is currently renting out 19 of their 27 properties, and they're working to decrease their geographic concentration through their acquisition of MGM Growth Properties. This acquisition is adding 15 new properties and is estimated that Caesars' total contribution to Vici's revenue will decrease to just 41%. The acquisition is also likely going to make Vici the largest landowner in the Vegas Strip. So with their low discount combined with the acquisitions that they're making to grow into an even more robust company, I think that they're trading at a very good valuation and have a lot of room to grow into the future. For stock number 4, we have something that I had written off as a stock that would just keep going up and would have a lot of trouble getting back into a good buying range. And that stock is Visa. Visa has fallen 15% from its highs back here in July. And I'm sure most people know what Visa does, but if not, they are one of the 2 major credit and debit card providers along with MasterCard. There's a few other ones, but those are the 2 big ones. And they make their money from a bunch of different ways, like a small charge to vendors on every transaction made with their cards, international currency exchange, and a whole bunch of other ways. Visa's revenue and EPS have both grown by 14% year over year, and they have good tailwinds to grow more as international travel continues to ramp up and people increase their spending habits again. MasterCard, on the other hand, has grown their revenue by 13%, and their EPS grew by 27% in that same time. Both have been doing very well coming out of the pandemic, but Visa's share price has fallen to the point where I think it's actually a good deal. MasterCard is still pretty expensive where it is. With this calculation that I have here, I get the fair value for Visa and this is including a 20% margin, being around $222. And it is currently 4% below that. So there's a big margin of safety between where it is now and where I think the fair value of it is. The financials definitely deserve a deeper dive because they're looking really good at this point, just from this quick glance that I've gone through. Visa is not a high-yielding dividend payer by any means. The current yield is about 0.7%, but they are growing it extremely fast. The 5-year compound annual growth rate is almost 18%, and they have a really low payout ratio around 21%. So they have a ton of room to grow. Even if revenue stagnated, they'd have a bunch of room to grow. And that's not really expected to happen. And they just recently increased their dividend from 32 cents to 38 cents, which is an 18.7% increase. There's definitely some risks to Visa, but I would say that they're pretty limited, at least right now. In the credit and debit card space, there are a few competitors, but the big one is MasterCard. MasterCard is a fair bit smaller. Their market cap is about $100 billion less than Visa's. They also make a lot less revenue, and they have much smaller profit margins compared to Visa. There's also the risk from a lot of the fintech companies like Square and PayPal eating into Visa's revenue, but those companies still have a long way to go before they would be able to start seriously putting the hurt on Visa. Overall, I really like what I'm seeing here with Visa, and I'm going to personally do a deeper dive on this one to make a decision on whether or not to enter this company, because I think it's looking like a pretty good deal right now after this big pullback that's had over the last few months. And last but not least, for stock number 5, we have Johnson & Johnson. Johnson & Johnson has a huge brand. They make everything from Band-Aids to Neutrogena to one of the COVID vaccines. Their huge brand has allowed them to become one of the largest healthcare companies in the world, and they still have strong growth projected for years into the future. Revenue growth has been a little slow for Johnson & Johnson over the last 2 years, but it's already started to ramp up again. From the end of their last fiscal year to the trailing 12 months, revenue is up by 10% and earnings per share is up 21%. They also just announced this Friday that they are going to be spinning off the consumer products part of their business and focusing more on pharmaceuticals. I personally think this is a great idea and will allow them to really hone in on the largest and most profitable part of their business. Pharmaceuticals is their fastest growing part of the business, while consumer products have been a lot slower to grow. So this will allow the pharmaceutical part to be valued much better than it would be combined with the consumer products part, and the consumer products part can also be valued at a better price. Typically with these large conglomerates, the individual parts of the company, when they're added together, aren't worth as much as they would be if they were separate companies. So it's expected that the value of both of these companies will increase more separate than they would together. Now, I personally don't think that Johnson & Johnson is as undervalued as some of the other ones on this list, but I do think it's at a good discount from its fair value. I get the fair value to be around $180 using this calculation here, so there's around a 10% discount. J&J is such a reliable company that any discount is usually good, and if it happens to go even lower, all the better. Johnson & Johnson is known for their dividend. They've been growing it consistently for almost 60 years. The starting yield is about 2.6%, and they have a really decent payout ratio of 43%. It has a good growth rate at just under 6%, so they have plenty of room to continue to grow, and they aren't growing it at a rate that is catching up with their average earnings, So they're going to continue to grow at this rate for years in the future. Johnson & Johnson is probably one of the safest companies that you can invest with. Every now and then they'll have their bad news that comes out, like the whole issue with the talcum powder. But in the long run, that's not going to affect the core business, and they're going to be able to move past it and continue to grow just fine without it. J&J is really safe, especially with their credit rating. Them, along with Microsoft, both have better credit ratings than the United States government, so they're both very safe companies. J&J has been around for over 100 years. They make a huge amount of essential products that people use all the time, and they're one of the leading pharmaceutical companies in the country. So if I had to bet on just one company in the healthcare sector, it would be Johnson & Johnson. And now that I've really looked into their valuation, I kind of think that they're at a good discount. So it's definitely worth taking a look and seeing if you want to be buying them here. And at last, that is the end of the video. What did you think of the list? Were there any companies that you think I should have mentioned, or are any of them too expensive for you and you think that they're definitely not trading at a good discount? Let me know in the comments below. But for now, that's all that I've got, and I'll see you all next week. Bye!